Accounting Academy. This is your CPA Kiwewa. In today's video, I'm going to take you through a practical example of statement of cash flow. Remember, I talked about cash flow statement as a statement that shows money coming in the form of cash inflows and money going out in the form of cash outflows. I tried to explain in the previous video. Today, I'm taking through a practical example. Let's take a look here. When we take an example here, we look at this example, we are saying the following balances, the following balance sheet for Edinand. In other words, as I told you last time, they are going to give you information from balance sheet, they will give you information from income statement, then thereafter they ask you to prepare statement of cash flow. When you look at this example, we have a balance sheet for 2020, we have a balance sheet for 2021. And they are showing you so that you can make a comparison what happened in 2020 and what happened in 2021. As we are adjusting, we shall be able to identify the money which came in the business in between 2020 and 2021 and the money we spent in between 2020 and 2021. We have assets, and under assets we have non-current assets. When you look at this machinery, in 2020 it was 1 million. Then when we crossed to 2021, it came to 1,078,000. Then we have current asset. Now this is just an example. You may find under non-current asset they may put other or more examples of non-current, like property, plant and equipment, like land, like building, you know, machinery is given here among other non-current assets. But here for learning purpose, I have brought only machinery. Then we have current asset. Still under current asset, we have inventory. And you are seeing here, under 2020, it was 93,400. But when we went to 2021, it had reduced to 89,200. Then we have debtors here, these accounts receivables. Someone may give you accounts receivables and may get confused. Accounts receivable in 2020 it was 30,800. Then in 2021 it is reducing. Then we have electricity. Let me try to highlight so that you can try to. Then we have prepaid electricity. The electricity which is paid in advance in 2020 was 3,950. Then 2020 it reduced as well. So when you look at our current assets are reducing. Then we have cash. Remember I told you cash, yes, it is a current asset, but we are not supposed to adjust it. Why are we not supposed to adjust the cash? Because that's what we are looking at. We are looking at the cash movement. Now, if you adjust at this point, it will not give you a clear picture. That's why we are going to adjust the current assets, but we shall eliminate this cash. This will be our balancing figure, as we shall see in our example there. Then we have share capital, which is separate. It is separate from this current asset. Share capital, it was 1 million in 2020. 2021 it went to 1,060,000, meaning the company issued more shares, you know, worth 60,000. We shall see how to treat that. Then we have current liabilities, and under current liabilities we have creditors. 2020 it was 28,000. Then 2021 it went to 48. Now when you compare that, you see there is some increment or increase of 20,000. We shall see the difference there. Then under longer term liability, you know, there we have things like loan, debenture. When you look in 2020, it was 50,000. Crossing to 2021, it is 0. What does it mean? It means this debenture was cleared, was paid. That's why in 2021, it was 0, meaning money was spent. We have some cash outflow there. But they are giving us even additional information here. They are giving us net profit before tax. Now, instead of putting here income statement, they have summarized some information from income statement. They have gone to income statement and they pick the net profit. When you pick net profit, it means you have summarized the revenue, the expenses for you to come up with net profit. So sometimes you may find a question whereby you have balance sheet and income statement, or they can give you balance sheet, then they summarize for you some information under what we call additional information, but picked strictly from our income statement. Now here, the net profit before tax, it was 30,000. We shall see. There is even depreciation for the year. Now here they are trying to show you, for them live or to get this net profit, they had also included depreciation under operating expense. Don't forget, in income statement, we prepare using accrual basis, but as we are preparing cash flow statement, we are using cash basis. Meaning, since this was adjusted or was subtracted in income statement, in our cash flow statement, we shall have to add it back because under laws governing calculation of cash flow, it is not allowed to consider non-cash items, as I explained in the previous video. Then we have cash dividends declared during the year and additional machinery. Now, when you look at this note 4, they are saying additional machinery was 78. Let's go back to balance sheet to prove whether it's true the additional machinery was 78. When you check here, machinery in 2020, it was 1 million. Going to 2021, it increased to 78, meaning they bought more machinery worth 78. It is here and even under additional what? Additional information. Required. They are required to prepare a non-limited cash flow statement for the year ended 2021. I think we are good to go now. We are good to go. I gave you this format in the previous video. The format, clearly you have to put the title, put the column for details. We are going to put our details, the amount column and amount column. Then we can start to prepare our statement of cash flow. Don't forget, I told you cash flow statement is divided into 3 major titles or activities. One, we have what we call operating activities, the ones we spend money or we receive money from the normal operation of the business. Then we have investing activities. There I talked about when we are either buying non-current assets or long-term assets, or we are selling the money we get or spend through those non-current assets. We put other investing activities. And then we have financing activities where we are looking at the financing of the business. Either you are issuing shares, you are issuing debenture, you are issuing the loan you are receiving the loan or you are paying back the loan. The money and the cash movement under there we record under what we call financing activities. Now, since I have said we divide into 3, let me start with operating activities as our first activity here. Operating, we use here. Operating activities. Or we can say cash flows. Sorry. Can say cash flows. Cash flows from operating activities. Now, when you look at our format I presented to you in the previous video, I told you start with net profit before interest and tax. But someone would wish to know, why do we start with net profit before interest and tax? The reason is very simple. This net profit is obtained through the normal operations of the business. By looking at the sales or revenue of the business, we subtract the expenses incurred. What remains will be our profit. But remember that profit was obtained by using accrual basis of accounting. Here we are using cash basis. We need to start with that net profit. We add just towards cash basis. That's why here, when I pick the net profit before tax is 30,000, just pick this. Just pick this and record under your cash flow from operating. Net profit before tax, interest and tax. And tax is given as 30,000. How do you adjust this net profit? Everything which was included in the income statement for us to come up with this net profit of 30,000 is okay and acceptable, except the non-cash items. Which non-cash items? I told you those are things which do not involve movement of money. Money is not coming in, it's not going out. For example of depreciation is non-cash in nature. We have gain on disposal of an asset, could be a loss on disposal of an asset. If they are given, please bring them in. But you need to know, when they were preparing income statements, for example, for depreciation, how was it treated? If it was added in income statement, here we shall subtract. If it was subtracted, like for the case of depreciation is an expense, in under income statement, we subtract it from we subtract it from gross profit to get a net profit. Here we shall have to add it back because it is not allowed under cash basis. Therefore, we shall come here and we add back depreciation because it was initially subtracted when we were preparing income statement. So depreciation, you will find it either in income statement if it is given or under additional information. If it is not given, still no problem. But here it is given, that is 7050. You have to bring 7050. But if we had items like loss on disposal of an asset, non-current asset, we add it back because it was also subtracted under operating expenses. If we have any gain on disposal of an asset, we subtract. Why? Because it was added in income statement. You know, we are comparing, we are using income statement and we are using balance sheet to prepare cash flow statement to show the movement of cash between in our business for a given period of time. Hope for depreciation is okay. We add it back because it is non-cash in nature, and yet cash flow statement deals with only cash item. Then from there, we are going to adjust working capital items, or I can say adjust working capital items. Adjust working capital items. You know, working capital, when someone talks about working capital items or working capital, we are basically looking at two concepts or two main components that make up working capital. That is current asset and current liability. Don't forget, where do we find the current asset or current liability? That is in the balance sheet or statement of financial position. And I told you current asset, we have things like inventory, things like debitors or account receivable, things like prepaid expenses. You go to the balance sheet which is given, you identify those items, bring there after adjusting. Then you look under current liability, still in balance sheet, look at things like accounts payable, bank over or short-term loans. You adjust them, you check the movement between year 1 and year 2. The difference will show you whether it is an increase or decrease. Then you will be able to know this is a cash inflow or cash outflow. Remember what we are trying to check here, the cash inflow and the cash outflow, and we see the movement, then we can reflect. Then at the end, we shall be seeing or identifying the actual balance or cash bank balance have at hand. Yes, when you look at working capital, you start with this. Let me get here my calculator. Calculator here. Then we shall start. We have here inventory. When you look at this inventory under current asset, inventory, that is current asset. And I told you we are going to adjust items of working capital, the current asset and current liability. Inventory in 2020, it was 93,400. Yes, 93,400. Then in 2021, it reduced to 89,200. Now, this is a reduction from this one to this one. There we can get now the word to use or the detail to use. We can say decrease in inventory. If it was increase, we put increase in inventory, but we have seen it was a decrease because in 2020 it was 93,400. Then 2021 it went to 89,200. Decrease in inventory of 4,200. Now the question is here very simple. Remember, we are trying to check, is it a cash inflow or a cash outflow? When money is, when inventory is increasing and when it is decreasing, you need to know where is it implying the cash inflow. Take a look here. Why is this inventory is decreasing? The only reason why inventory can decrease is by selling it. So as you sell inventory, you had 93. By the time we are balancing under 2021, it is reducing, meaning you sold some inventory worth 4,200. Meaning, as you are selling goods, money is coming in the business. As money is coming in the business, that is treated as a cash inflow. And there you leave at that stage. Don't put any negative or bracket to show that we are subtracting. We leave as positive because it is a cash inflow. Remember, if it is a cash inflow, we leave it as a positive figure. If it is a cash outflow, we put bracket or minus to show we are subtracting money. We all agree now, decrease in inventory, we have sold inventory, that's why it is reducing. We leave at that point. Then we go to another item. We have debitor or accounts receivable. 2020, 30, 800, then 2021, this is 30, 800, then 2021 it is 21, 100. Now, this is also a clear decrease in accounts receivable from 30 to 21. Here you put decrease in debitor, which is 9,700. Now, still, debitors or accounts receivable, those are people you are demanding your money. You sold the goods to them on credit and they did not pay. But now, in 2021, in 2020, there were so many that by the time you entered 2021, they had reduced. What does it mean? It means they have paid. As they are paying, cash is coming in the business. You leave at that point as a positive figure. Let's look at prepaid electricity. The electricity or the expense you pay in advance. In 2020, it was 3,950. Then in 2021, it went to 3,000. Meaning, we have also a decrease of 950. Here you bring decrease in prepaid expense or electricity. It is very clear given electricity 950. So 950. This is very clear. You have been paying money in advance. Now you are reducing, it's like you are saving. As you are saving here, we are looking at that as a cash inflow. The moment you are not spending and you are saving, instead of spending, you keep your money. We look at that as a cash inflow. We record as a positive figure at that point. I talked about cash. That when we are adjusting items of current assets, for cash don't adjust. We shall use it as, because this is what we are looking, our final answer, we are looking at this 20,000. So we adjust other items, for cash we leave it, we shall look at it at the end of this question. Let's go to current liabilities. Here we have only one item, that is, we have creditors, or someone may call this accounts payables. Accounts payables. In 2020, it was 28,000. Then in 2021, it went to 48,000. Are you seeing this is an increase? We have been looking at decrease under current assets. For current liability, now it is increasing from 28 to 48. You bring here increase in accounts payable, or we call them creditors. Yes. By how much? 10,000. Now I know you are asking. This one has been decreased, and we are saying this is positive. Since this is increase, should we say this is negative? Let's try to think about this. Don't forget, this is current asset, this is current liability. Now, for current asset, the moment it is increasing, current asset, notice this, the moment current asset is increasing, just know that is a cash outflow. We're going to increase by buying or by spending money to acquire that asset. But when a liability is increasing, like for this case, it increased by 20,000, it means you are delaying to pay the suppliers. You are delaying to pay people who are demanding money from your business. Meaning, since you are not spending or you are not paying them, we treat that increase in the accounts payable or in a liability as a cash inflow. So the moment you see a liability is increasing, just know that is a cash inflow. All right. Hope we have exhausted our current asset and current liability. Remember, I said we start by net profit before interest and tax. We adjust with non-cash items. After that, we adjust items of working capital, that is current asset and current liability. After that, if you have any tax which was paid, please, you subtract at that point. If you have any interest which was paid, subtract from that point under operating activities, because this shows net profit before interest and tax. After going through this, suppose you have any tax paid, you subtract from here. Any interest, subtract from here. Then after, we shall get what we call total or net cash flows. Let's add this. Net cash flows from operating activities. Strike add. Net cash flows from operating activities. Remember, you have to separate cash flow from financing, operating, investing. That is 30,000 plus 750 plus 4,200 plus 9,700 plus 950 plus 20,000, and you get 7,900. Yes, don't forget, we are using what we call indirect method. And the indirect method, it starts with net profit before interest and tax. We adjust that. After adjusting, how do you adjust it? By considering the non-cash items, either by adding what was subtracted in income statement or by subtracting what was added in income statement. Like for depreciation, it was subtracted in income statement and operating expenses. Here we have to add it back because under cash flow statement, we're using cash basis. Then we go to working capital, you add just either by adding or subtracting. We are lucky enough that all our items here were cash inflows. That's why I'm adding them back. If we had any cash outflow, I would be subtracting. Let me look at another component of cash flow, that is cash flow from investing activities. Cash flows from investing activities. And cash flows from investing activities, I told you we are basically looking at long-term assets or what we call non-current asset. You go to balance sheet, look under the part for non-current asset, only the item which are there. Non-current asset, either you are buying or you are selling, you bring the difference, you record it there. Look here, look at this asset. Under non-current, remember for current, we have already adjusted. Under non-current, we have only machinery here. We have only machinery. In 2020, it was 1 million. 2021, it went to 1,078,000. Even here, an additional information they're showing you, the additional machinery was 78, meaning you spent money to buy the machinery, additional one, machinery worth 78. As you are spending money, that is cash outflow. We are going to subtract from the cash we have, either from our bank or from our cash at hand. Just bring here. If it is increasing, I would write here increase in machinery, but the right word would be purchase, because it's increased by purchasing or buying, purchase or machinery. How much? Is 78,000. But for this case, I'm going to put bracket, meaning I'm subtracting, because I spent money, I spent 78,000 to acquire this machinery. Whenever you see that it's the cash outflow, money is going out of the business, you put bracket. Or you can put minus, no problem. That the wise way, the professional way, the accounting would be, we put bracket. Whoever can see that, will know that that is a minus. Then since we have only that item under non-current asset, we can get net cash flow. With this net cash flows from investing activities, and our total just get 78,000, but still as a minus. We are done with cash flow from operating activities. We are done with cash flow from investing activities. Remember, I said there are 3 components. We are left with which activity? That is cash flows from financing activities. You come here and put cash flows from financing activities. Here, someone will be asking, where can we find this cash flows from financing activities? Here we are going to look at, let me start with operating activities. I said you look at net profit before interest and tax, adjust with working capital. When you go to investing activities, you only look at non-current assets. But now when you go to cash flow from financing activity, only two elements of balance sheet we have not tackled here. We have not handled yet. That is the equity part or components of equity, that part, and the longer term liability or non-current liability. Meaning I'm going to look at the share capital there, then I go to longer term liability, I pick and I finalize my financing. Let me start here. When you check here, share capital is already given here. Share capital is here. Share capital. In 2020, it was 1 million. In 2021, it went to 1,060,000. Meaning, you issued the more shares. When you issue shares, you are raising capital. You are selling your shares to the public and you get more money. Meaning, this difference of 60,000, when you subtract this minus this, 60,000 is a cash inflow. We just take the other side, and here I will put increase in shares, but the right word will be because shares increase by issuing, right? Then we can say issuing of shares. How much? 60,000. Since you are receiving money, it's going to be treated as a positive figure, cash, to represent or to show that this is a cash coming in or cash inflow. Then I talked also about the longer term liability or non-current liability here. We have debenture. If you have non-stick, you look what is this. In 2020, it was 50,000. But by 2021, it is 0. What has happened? This is wrong. What has happened? Now, the answer will be, it can only reduce if you have paid. Like when loan in 2020, you had it 50,000. Then when you close to 2021, it is 0. It means you paid. You spent 50,000. We go there and here, payment of the venture, 50,000. We just get the difference. But since you are paying this time, we shall put bracket to show it is a minus. After that, you come back here so that you don't leave any item unrecorded. You go through non-current asset, we cleared the machinery. Current asset, we cleared inventory, we cleared creditors, prepaid, except the cash. As I said, you first eliminate that. Then you go to share capital, we have cleared that. Creditors, you have cleared that. Debenture, we have cleared. When you go under additional information, net profit is already recorded, depreciation recorded. Then there is this one, cash dividend declared for the year, 12,000. That is also under financing activities. You record that you declared 12,000 dividends, which are to be paid to shareholders. So you bring here, can even call dividends here. Dividends, it was 12,000. Since you are going to pay to shareholders, that one is treated as a cash outflow. Money is going out of the business. When you go through now, we have not left any item unrecorded except cash. And cash we are going to see, we are going to also to record it. But the reason why we are not adjusting cash, that's what we are looking to. We are going to look at the cash movement, the money we started with, and the balance. Then we shall get to know how the money was moving within a given period. When you add this, when you add that, let me get very fast. It is 60,000. We are subtract 50,000 and we subtract 12 what? 12,000. We shall remain with 1,000. Shall remain with our 2,000. But that 2,000 as what? Minus. Then this is called net cash flows from financing activities. Net cash flows from financing activities. We have managed to go through the cash flows from operating activities. Very clear. You look at net profit before interest and tax, add just with non-cash items, depreciation, gain on disposal, loss on disposal. You add just working capital items, you see. Then after that, close to cash flow from investing activities, you look at non-current assets. You add just, if it is reducing, it means you sold. There it will be like a positive figure. But since it increased, it means you bought and you spent money to buy machinery worth 78. You go to cash flows from financing activities. You look at the share capital. You look at the long-term liabilities, among other items there. Then after that, we have now 3 figures. We have total here, if you can see, net cash flow from operating activity, which is this. We have net cash flows from investing activities, and we have net cash flows from financing activities. When you add those 3, you are going to get what you call either increase or decrease in cash and cash equivalent. So here, if it when I add this plus this plus this, if our answer is positive, we shall say increase in cash and cash equivalent. If it is negative, it will be decrease in cash and cash equivalent. But let me use both, then you will pick depending on our answer. Increase, stock decrease in cash and cash equivalent. When you add this plus this, let me call this like A. Let me call this one like B. Let me call this one like C. So when I add A plus B plus C, I'm going to get 8,100. But now, I don't know whether you can see that this is 71,900. This is 80, meaning we are getting a negative 8,100 at that point. There is a component I told you first leave, and that was cash. We have cash at the beginning and cash at the end, or cash for year 1 and cash for year 2. You bring cash for year 1 as our balance, wrote it down, or what we call opening cash balance. Opening cash balance, or call this balance. Let me put it here, balance PT. You come here. When you add A that is net cash flow from operating activities, B net cash flow from investing activities, and C net cash flows from financing activities. When you add, you get 8,100, but negative, because this is 71,900. This is 78. This is when you add this. This is 80,000, but it is a negative figure. When you add this plus this, you come up with negative 8,100. You bring increase. Now, when you look at this, is this increase or decrease? Of course, it is a decrease because it is negative. It would be, even if I don't bring this word increase, that I start from decrease in cash and cash equivalent, which is 8,100. After that, bring opening cash balance. Pick from here. Cash is already here. I told you don't adjust. Bring the cash for year 1. That is the balance brought down. Beginning balance in 2020 was 28,100, but it is positive. You bring it here. 28,100. When you add this plus this, automatically you must get closing balance, which you have in your balance sheet. Closing cash balance, or what we would call balance carried down. When you add this plus this is negative, this is positive. The remaining will be 20,000. To confirm that you are right, this closing balance must be the balance for year 2. When you look here, our cash in opening balance was 28,100. Closing balance is 20. The figure we have calculated the other side as our closing balance. So this is the confirmation, at least, that we have tried to comply with the principles governing preparation of cash flow statement. As we are adjusting the non-cash items, we adjusted the working capital, we adjusted everything which is supposed to be adjusted. We have managed to show the cash inflow and cash outflow. The moment you do this and you look at this, there are three items here: decrease or increase in cash and cash equivalent by adding those three items: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. Bring your cash balance at the beginning of year one. Once you add this, automatically you will get the closing balance for year two, or what we call balance carried down. Cash flow statement is really very easy to prepare. The moment you understand that it is prepared based on cash basis principle. 2, we need to eliminate any cash item. 3, we always prepare by comparing, trying to adjust items of income statement like net profit and the items of balance sheet. You've seen that we have adjusted all items of balance sheet. This was indirect method. Don't forget, I told you the only difference between direct method and indirect method is that it's under only operating activities. The rest, like cash flow from investing, cash flow from financing, the same way we prepare for direct, the same way we prepare for indirect. But the difference comes with how to determine the cash flow from operating activities. Keep yourself with Pro Accounting Academy. I'll be coming right back and I show you how direct method works. Don't forget to subscribe if I told you have benefited from this video. Share, like, and keep yourself with Pro Accounting Academy. Thank you very much. See you again.